Hello, everyone, and welcome. We have another great session in store for you today. But before we begin, I'd like to take a moment to once again thank everyone for being here, and also to express that our thoughts and prayers are with all of you at this challenging time. We'd also like to extend our gratitude to the many who have been working so hard to keep everyone safe and well, and also helping to keep our critical supply chains intact. Our thanks to all of you. By way of introduction, I'm Rodney Sullivan. I am the Executive Director of the Richard A. Mayo Center for Asset Management here at the University of Virginia Darden School of Business. It is my pleasure to welcome you all here for today's call. For those of you new to the series, the Mayo Center is a center of excellence at Darden with a focus on applied academic research and education. And consistent with that mission, the purpose of this seminar series is to advance the study and practice of asset management through, of course, research and education. I'd also like to take a moment to thank our co-sponsor for this series, the Financial Management Association International. Now, let me take a moment to share a few housekeeping items with you for today's call. All participant microphones have been muted and videos are turned off. For those of you having questions for today's speaker, we ask that you please send them via the Q&A box located at the bottom of your screen. We will collect these questions throughout today's session, and we'll put as many of them as time allows to our speaker following his prepared remarks. Note that you can download Marcos's slide deck from the Events tab located on the Mayo Center for Asset Management website. And in the coming days, we'll post a recording of today's session on this same site. Okay, with that, now let's move on to today's program. It is my pleasure to introduce our moderator for today's program, Professor Mark Lipson. Mark is the Robert F. Vandal Professor of Business Administration here at the Darden School of Business. Mark, thank you, and over to you.
Thank you, Rodney. It is great to see so many of you here and so many of you returning back for our webinar series. Obviously, we've passed an important market test. It is my distinct pleasure to be the moderator today for our discussion with Marcos Lopez de Prado. Marcos is someone that I would be willing to describe as a visionary, a luminary, and very much an influencer in the world of quantitative investing. He is someone who is willing to go where no one has been willing to go before, to think broadly and differently about what we do and how we do it. And someone whose comments today I am very much looking forward to. Don't forget to send your questions in. We'll pass those on to Marcos after he has gone through his prepared comments. Marcos is the founder and chief investment officer of True Positive Technologies. He is also a professor of practice at the Cornell School of Engineering. He was head of machine learning at AQR, founded and led Guggenheim Partners Quantitative Group. He is a man of tremendous experience and, as I've said, bold thinking. So with that, let me turn it over to you, Marcos, and then we shall proceed.
Thank you, Mark. Very excited to give this talk, and I look forward to your questions. Let me share the presentation so that we can all look at the same screen. Today's talk is about the lessons we can all learn from COVID-19. As you know, the SARS-CoV-2 virus was isolated on February 11th, 2020, and yet the market continued to rally for 8 days after the virus was already identified, and there were many cases recognized and confirmed in China. Many quantitative firms experienced substantial losses over the following weeks. And this is particularly troubling among firms that are supposed to be market neutral. How is it possible that these strategies are delivering performance that is supposedly uncorrelated to the market, and yet they experience substantial losses, 10, 20%, almost as much as the market in some cases. And what we're going to see in today's presentation is that these firms are not incorporating some of the lessons from the past. We're going to discuss how to prevent these kind of losses in the future. This work is in collaboration with Professor Alex Lipton. Lesson number one is more nowcasting, less forecasting. What do I mean with that? Well, forecasting means using structured data to make long-range predictions. Traditionally, quantitative firms have used a variety of data sets to forecast prices. Typically, forecasts come in two kind of flavors. One is time series dynamics. So that's the traditional ARIMA, ARMA, vector error correction models, etc., that are attempting to forecast prices based on prior price dynamics and also lag variables. Traditional firms that exploit these kind of models are standard firms and CTAs. And the second flavor that you can recognize is the use of cross-sectional data in order to incorporate recognize relative value opportunities. Firms that do that are firms investing in risk premia, factor investing, firms that use asset pricing models. Forecasting relies on statistical relationships that are supposed to be stable over time. Unfortunately, many of these relationships are not stable over time and they do not hold. And when they do not hold, these models do not perform as expected. So one problem is the assumption that these relationships are going to hold under stress. Another problem of this forecasting approach is that typically the data sets used to make these forecasts are somewhat limited. They are short, they incorporate very few variables. They are the kind of models that made a lot of sense years and decades ago when we had very little and stale information. So whenever market conditions change quickly, because the frequency of the data is not high enough, the model is not able to adapt. The model is not able to learn the new reality. And that exposes these investors to substantial losses. Nowcasting is different. Nowcasting means modeling unstructured data, data that is not coming in a nice tabular form, in order to accomplish two things. Number one, direct measurements. That would be the example where we are trying to estimate inflation in real time, rather than trying to estimate the next month or quarter's inflation based on some lag variables. We would make real-time estimates of inflation by web scraping data or by other procedures. So this is not really as much a forecast that incorporates a causality mechanism. This is a forecast directly on the variable that we are trying to predict. It's a direct estimate. The second application of nowcasting is short-range predictions. This is very typical in market microstructure models, for instance, where we are trying to predict whether market makers are going to widen their bid-ask spread, or are they going to pull out of the market. And it's a short-range prediction. It's based on very actual information. And as a result, these relationships tend to be more reliable. We are not trying to make these short-range forecasts based on long-term equilibriums or relationships that tend to be verified in the long run. We are trying to make these predictions based on short-term causality mechanisms that involve millions of independent observations. So the model will be able to adapt and adjust, learn the new reality very quickly. What you can see here on the right side is a plot of the Billion Price project, which was initiated at MIT. And they are able to produce rather accurate estimates of inflation in real time by web scraping millions of prices online. And they are able to do that around the world. Think of nowcasting outside of finance. I find it very interesting to find applications of nowcasting in finance by learning how nowcasting is used outside of finance. One example of nowcasting outside of finance is detecting earthquakes. We cannot predict earthquakes with any reliability. We don't know when they will happen. We don't know exactly where they will happen. Of course, there are some faults and some areas on the planet that are especially prone to earthquakes, but we don't know exactly when and where and the magnitude. So when we cannot forecast this kind of phenomena with any reliability, instead what we do is we develop early warning systems. Here the goal is to alert the people who are going to be impacted by the earthquake as soon as possible. And just a few seconds of warning can save thousands of lives. In the case of the California earthquake system, they are able to warn individuals with up to a minute before they start to receive the shocks. So earthquakes are not being predicted, they are being detected. And once they are detected, we evaluate what populations are going to be impacted. These individuals are alerted by cell phone messages or by other means of communication. And in the case of tsunamis, the alert can occur even hours before the shock wave arrives. And what I can show you here in on the right plot is the expansion of the Sumatra tsunami that occurred on December 26, 2004, and that displaced over 1 million people. Well, you can see that some affected areas receive warnings of up to 5 hours in advance. Going back to finance, I believe that this illustrates the power of nowcasting for investments. Forecasting is the mathematical analog to guessing. We're trying to guess something based on some hints, some signals. But when we're nowcasting, we are not guessing. We are observing the phenomenon and we are trying to adapt and learn as soon as possible. So it's a case of the earthquake. We're not trying to predict the financial earthquake. Once a financial earthquake occurs, we are trying to adjust. And of course, in the case of COVID-19, we had 8 days in advance, more than 8 days when you think of the effects that were already taking place in China to adapt and adjust. There are many different examples of nowcasting in finance. One case is what we just saw before, inflation forecasting, how to web scrape millions of online prices in order to produce very accurate estimates of inflation, with applications, of course, to trading fixed income securities, credit, short rates, forex exchange, you name it. The second example is nowcasting liquidity conditions. And that's something that market makers, liquidity providers, high frequency traders are experts at. They evaluate millions of messages, fixed messages in real time in order to adjust and prevent the adverse selection. The earnings of retailers can be nowcasted as well using satellite images, parking lot occupancy, email receipts, etc., to the point that we can have a quite good expectation of what is going to be the revenue of a retailer at the same time as the executives of the retailer. We don't need to wait for the quarterly statement. And then another example would be industrial production, where using engineering data sets, cargo shipments, auto production numbers, electricity consumption, etc., we can also evaluate what is the production level of and level of occupancy and utilization of various factories. On this plot, what you can see is that a data provider was able to recognize that Best Buy was obtaining very large revenue during the 2019 holiday season. And this estimate occurred months before this information was reflected on financial statements and therefore assimilated and used by, for instance, factor investing firms. So that gives you the ability to adjust and incorporate this information months before other firms incorporate this information through traditional means. Now, let me give you an example of nowcasting in practice. We first identify a cause-effect mechanism. For instance, we may assess how unemployment impacts consumption and how consumption impacts retailers' revenue, right? Unemployed people, unfortunately, do not have the means to consume certain items. And given this cause-effect mechanism, which we don't need to guess, we understand very well how it occurs. Now we can develop an investment strategy that is going to monetize that mechanism. So for instance, this investment strategy may buy certain retailers that have most of their presence in regions that are hiring, and we could sell retailers that are present at areas that are experiencing most of the firings, most of the layoffs. In the third step, what we do is we evaluate the performance of this investment strategy, assuming perfect knowledge. Why do we want to assume perfect knowledge? Because if the strategy doesn't make money with perfect knowledge, then feeding the strategy is just only an invitation to overfeeding. It's an invitation to try to predict noise, which of course is not going to happen. Suppose that this strategy with perfect knowledge makes money. In the backtest, we evaluate with perfect knowledge, it has a Sharpe ratio of 2. Okay, so the next step is with this model that is fitted to information with perfect knowledge, now we're going to replace the variable that incorporated the perfect knowledge with the variable that is nowcasting. Why are we doing this? Because now we are using a model that is fitted to the perfect knowledge, and we are replacing that with a direct estimate of the perfect knowledge. So in this case, for instance, we would use satellite photos that evaluate traffic and parking lot and foot traffic, not only car traffic, around certain areas in order to evaluate whether, to what extent there are layoffs or there is a change in employment or in the pattern of workers. What I'm showing you here is a famous photo of Korea, North Korea and South Korea in the night sky, and you can very well tell which one is. Of course, South Korea is in the south, but in addition, you can see how much light South Korea emanates in the night sky, while in the north, clearly there is not much going on. Well, satellite images are used today to track cargoes, assess yield crops, predict oil output, and many other things. Going back to COVID-19, days before the sell-off started, there were plenty of warnings that the virus was impacting the economic activity in China. You can look at that in terms of copper demand, but also, of course, in terms of factory use and traffic. The lockdown was having a tremendous impact in the supply chain. And the market kept rallying. So thanks to nowcasting, in fact, market makers did not experience losses during the sell-off. Market makers are perhaps the most common users of nowcasting. When they read millions of fixed messages on a daily basis, that's essentially what they are doing. They're not trying to predict whether the market is going up or down. In fact, they are neutral, they are agnostic, but they are trying to predict whether there are informed traders, and they are using fixed messages in real time to do that. The conclusion is that if we use nowcasting going forward, we are more likely to avoid situations like this. No backtest can predict a black swan. No backtest can predict something like COVID-19, even though COVID-19 was not a black swan per se. Pandemics occur all the time. But no backtest can predict a pandemic. But pandemics can be identified very quickly and recognize that they are impacting the economic activity, and therefore market makers, just like market makers can adapt and did not suffer losses in the midst of a tremendous sell-off, other investors could have prevented these losses by utilizing the kind of techniques that market makers utilize every day. Let me go now to lesson number 2. Develop theories, not trading rules. We all know how investment strategies are typically developed. Essentially, what happens is that someone runs millions of backtests, and there will be a few backtests that perform really well. Those are selected, and then there is some explanation, a story that is put together to explain why a particular trading rule would work well, and that's the idea or the trading rule that is used to launch the fund or to submit to a journal. Of course, that's selection bias. We all know it's wrong, and it explains why many published discoveries do not hold over time, because the authors or the funds did not control for selection bias. The problem here is that backtesting is really a validation tool. It is not a research tool. Backtesting is very useful. We should all backtest our strategies, our ideas, our theories. Why? Because that's our fundamental validation tool in finance. However, think the way I described backtesting a minute ago. Backtesting is typically used to research theories, to research investment strategies, not to validate them. And when we use the same tool for validation that we use for researching, of course, it's a circular argument. We should develop a theory and then validate it by different means than the means used to come up with the theory in the first place. What I'm showing you here on the right plot is all the ways in which the theory of relativity has been tested over the past 105 years. Einstein could never think of the ways that his theory would be tested. He came up with a theory. The theory was intended at the beginning to explain some strange phenomena in the orbit of Mercury, and it ended up explaining much more. Researchers must come up with innovative ways to test the strategies. And backtesting is a very powerful tool for validation, not really for research. It's a powerful tool for validation, but we should do backtesting and more. And what do I mean with more? Well, suppose that we have a market microstructure theory that tries to explain how wide the bid-ask spread is as a function of order flow imbalance. We can, of course, backtest that theory, and if we develop a trading rule for that tries to monetize that information, but we should do more. We should look into the fixed messages and find evidence that, for instance, market makers are pulling out of the market when there is extreme order flow. We should identify days when there is extreme order flow and talk and ask market makers, what did you do that day? What did you do on May 6, 2010? Because in finance, unlike in other fields, we can ask questions to the agents involved in the phenomena. Physicists cannot ask questions to neutrons, but we can go and talk to market makers and evaluate their P&L and evaluate how they interacted with the market. So I feel that this is a tremendous opportunity that is not being used today. When you read most of the papers published at the top journals, typically it's a theory that is very well explained, followed by a backtest. And you always wonder, why do we rely so much on backtests? Why don't we go and figure out different ways to test and evaluate these theories, complementary of the backtest? So that's the second lesson. Develop theories, not trading rules. And once the theory is established, analyze the ultimate consequences of this theory. Lesson number 3 is avoid all regime strategies. we are all familiar with the kind of theories and models and strategies that are present in the academic literature and also offered by various asset managers. These strategies are typically all-weather strategies, and with all-weather strategies, I mean strategies that are supposed to work under all regimes. Examples are risk premia, risk parity, tail risk strategies like black swan strategies. These are strategies where you are putting your money all the time with the expectation that over time it will make money. And there are two problems with this approach. Number one, it implies that opportunities exist and markets do not learn, right? The opportunities are being extractable and can be monetized on a continuous basis. But the reality is that markets are adaptive, and investors learn from mistakes, and strategies become overcrowded. So instead of looking for these kind of holy grail all regime strategies, what we could do is to look for regime-specific investment strategies. What do I mean with that? For each regime, we can identify a data generating process that is responsible for the returns under that regime. So for instance, there will be a data generating process for a market that is near equilibrium, and there will be, or that is in an expansionary cycle, there will be another data generating process associated with an inflationary regime or regime associated with zero interest rates. And there will be other regimes, other data generating processes that characterize the kind of tail risk black swan episodes we observed in February and March. And the goal should be to develop a strategy that is optimal for each of these regimes. Rather than developing a strategy that is supposed to work all the time, let's come up with this kind of Swiss knife approach. And depending on the regime we are in, this is the strategy that we deploy. And we can use nowcasting to evaluate in what regime we are. So in that sense, we don't need to choose between risk premia and tail risk strategies. We should use both, but not all the time. There is a time for using risk premia, and there is a time for using tail risk strategies. And nowcasting can tell us which one we should use. Finally, let me conclude these remarks with knowledge graphs. I find knowledge graphs very useful in finance because they are a modern version of the covariance matrix. Covariance matrices, when you think about them, they are essentially a complete graph. They are a graph that links any two securities in the investment universe. But complete graphs, and the covariance matrix in particular, misses the notion of hierarchy. There are some sectors that are more correlated among themselves than the rest. And there are some countries, some securities within a country tend to be more correlated. Why? Because they are exposed to common risk vectors. And knowledge graphs encode that information in a way that respects these hierarchical relationships. We can have many different knowledge graphs based on, of course, returns, which would be the topological version of the covariance matrix, but also we can produce knowledge graphs based on business ties of various companies, supply chain, companies that are competitors of each other, in companies within the same industrial sectors, companies that share ownership, etc. We can come up with 10 different knowledge graphs, and each of them tells us a different story. And then what we can do is we can form an asset allocation based on each knowledge graph and then invest on the ensemble. Why I like this? I like this approach because on one hand, it's much richer than just using correlations, but also because it's forward-looking. Once you have a knowledge graph and something happens, like for instance, COVID-19, you can adjust this knowledge graph instantly. And now this knowledge graph is a forward-looking representation of the kind of of patterns, behaviors that will occur going forward. I think that this will be very useful to finance researchers in the future, because it means that we don't need to wait 5 years until enough information has entered the covariance matrix. And by then, probably we are in a different regime anyway. So rather than using backward-looking approaches, knowledge graphs are a very nice way to incorporate forward-looking information. If you like the kind of ideas that I describe, you can read this book, Advances in Financial Machine Learning, where they are explained in greater detail. And with that, Mark, I give the mic back to you, and I look forward to your questions. Thank you.
Thank you, Marcos. That was exactly what I expected. Fascinating, interesting, insightful, and enjoyable. We have over 370 people online, so very successful, and I'm sure as I am enjoying it, so are they. We were together, you and I spoke at the University of Virginia Investing Conference in 2019, and I love that discussion. And one of the things we talked about there was the democratization of trading, how more and more people have access to information, more and more people have access to the machine learning tools that you are so familiar with and are trying to make available. So then your argument was, we're going to quickly reach a point where everybody has access to these tools, trades happen so quickly, and alpha essentially goes away. So I'm loving this whole notion of nowcasting, and I wanted you to reflect on nowcasting in a similar vein. As more and more of us get access to nowcasting data, what can we see as an equilibrium? It seems, for example, to be something that might be very costly for some people to have. Is this something that will not be available to everyone, but may only be available to people with large amounts of resources? And what role might retail investors play then in a nowcasting world?
Excellent. Remember that what we discussed in 2019 was democratization in the context of trading. But in the context of investing, it's also happening. When you look at the past 10, 20 years, investors, an asset manager or portfolio manager would typically have to go through a very specific career path in order to gain the confidence and the trust of investors. Typically, it entails joining a certain bank after going to a certain school. Of course, University of Virginia being a great school for having a shot at the finance industry. But there was a particular cursus honorum that you had to follow in order to eventually becoming a hedge fund manager or portfolio manager. That's not the case anymore. And today, you can actually have a very successful career in asset management by becoming an expert at a particular technique. Why? Because what we are observing is the specialization, the division of labor in the asset management industry. In the past, we were looking for market wizards. We were looking for the individual who, with his bare hands or her bare hands, could manage a portfolio. No need for technology, no need for information, no need for code, no need for computers. Today, that's not the case. So what I mean with democratization today is that you are an expert in a particular field, whether it is economics, computer science, statistics, or trading, and you just need to be really good at this aspect of your job. That opens the space to millions of individuals who can join. Let's say that you have been a statistician at a bioengineering firm, and you have applied machine learning to identify extremely complex patterns in the genome. You can use that expertise now to nowcast, to analyze satellite images and evaluate very complex relationships. So that's what I mean with democratization. Today, if you have a very strong technical skill, including technical skills in economics and finance, you have a career path into finance, and it's no longer this sort of big boys club that it used to be decades ago.
That's a great answer and very insightful. So I have a lot of questions coming through the Q&A about nowcasting and sort of where the markets are going. And one simple question would be, if we start to really focus on nowcasting, are we going to make markets even more focused on very short-term results and very short-term information? And will there be a room for people thinking about things that affect longer-term trends?
That's a wonderful question. Nowcasting doesn't mean high-frequency trading. It means that you react very quickly. So for instance, suppose that you have two strategies in your portfolio, just two: value investing and tail risk. And now you use nowcasting to switch from one to the other. This switch is not occurring every day, it's not occurring every month, not even every year. From time to time, you need to make the switch. And you just need to monitor the markets to identify a probability of when to make the switch. And guess what? Sometimes what will happen is that you are 90% invested in value, for instance, or in momentum, and 10% invested in tail risk, which offers you a downside protection. So there is no need to choose, right? The beauty of nowcasting is that it allows you to build ensembles of investment strategies. And in that sense, I don't think that we are that we will see in the future that everybody is short-term and becoming a high-frequency trader. Not at all. What will happen is that we use high-frequency information to make long-term decisions.
And I like the focus on identifying regimes, because one of the questions we had is how would nowcasting help us think about trends? And your point is we can better identify one trend for another. We have quite a few questions on how this affects what we think of as traditional market-making types of roles and functions. So we get better, we get faster, and we think of the market as reflecting, well, in an old school model, we had market makers trading with uninformed traders and occasionally trading with informed traders. Now it seems those informed traders become so quick, they use information, they're so accurate, they sweep available liquidity. Do we think now differently about what a traditional market-making role might be?
I think market makers have evolved over the past 10 years. Remember what happened on May 6, 2010? We had the 10th year anniversary a couple of days ago. Market makers lost a lot of money that day. They were surprised. Why? Because they were not using the kind of techniques that they are using today. The flash crash was a very expensive day for many market makers because they were adversely selected. They were not monitoring the order flow imbalance. Fast forward 10 years, and February was horrible. March was horrible. I mean, there were days that we started with limit downs, and then the market would fall and go up and down, and tremendous volatility, tremendous trends intraday. And yet market makers had a pretty good day, pretty good month in March. So that's what nowcasting means, that once you are using real-time information, you become adaptive. And that doesn't mean that at the beginning of the changing regime, you will lose some money because, again, it's a surprise, but you are able to adapt and adjust much faster. And as a result, protect your investment.
And so we think of the market makers having built in these protections where they essentially run for the hills and get out of the way. And so very good, they've adapted. Help us understand nowcasting in a more positive sense in, oh, here's something where it's a signal and I'm going to jump in aggressively.
Yes, so for instance, in the case of COVID-19, once you recognize that there is a disruption to the supply chain and commodities are being impacted, commodities being a very good indicator of what is happening in the real economy, that's where, for instance, you would buy protection. You would buy out of the money puts. Buying out of the money puts is a very expensive proposition. It's something that typically when you do on an ongoing basis, it leads to a strategy that doesn't make money. But it can be a great proposition tactically. On a particular moment in time, you need that protection, and that's what you would do. So it's not necessarily that you need to sell all your positions and go into cash. You just need a temporary protection to manage this risk. Now, let me relate this to your earlier comment on market makers. Market makers that use nowcasting, that doesn't mean that liquidity evaporates, or essentially that these market makers are not providing liquidity. What it means is that they will adjust the bid-ask spread quickly so that they can remain in the market. You see, and that's what happened in March. The bid-ask spread widened, but there was no liquidity failure. During the flash crash, there was no widening of the bid-ask spread, and there was a liquidity failure. Market makers vanished from the market. So that's why nowcasting, what it means really is that market makers can pass the cost, the real cost of offering liquidity, and they don't go bankrupt. And that's important.
It's a great answer. You have a book on machine learning. You're a quant guy. And yet, when we've talked, you always advocate for the importance of theory. Let's think about theory, sort of. And I think many people would be a little surprised. We think about machine learning, artificial intelligence as being almost by definition theory neutral and almost entirely data driven. And so people are wondering about how do we understand a little better the role of theory in a nowcasting environment. I was very taken with your earthquake tsunami analogy, and in some sense, we need to have a kind of a theory or some past experience, even with nowcasting, to know that these things are going to happen. So help us understand a little bit about what kind of theories we would have, and then think a little bit about COVID. Could we have had some kinds of theory that would link to nowcasting and might have given us sort of an early warning mechanism?
Yes, so when you think of how machine learning is being used in the scientific fields, these are not black boxes. Scientists have no regard for black boxes. The whole point is understanding something that we don't, understanding the precise mechanism of how something happens. So when you think of how chemists, biologists, physicists use machine learning, it's truly to understand a phenomenon. And once the phenomenon is understood, they can theorize, and then they don't need machine learning. So that's the way I feel machine learning should be used in finance, not to produce trades and to forecast prices like coming out of a crystal ball. Instead, machine learning can be extremely helpful to identify what are the variables involved in a phenomenon. And once we understand these variables, regardless of the specification, now we can build a theory about how these variables interact. And that theory can be tested using econometric methods, etc. So that's the way I feel machine learning should be used in finance. You see, econometric models do not allow us to separate the specification search from the variable search. Everything is in the same package. When we run a p-value analysis, the p-value analysis is only true if the specification is true. That means that sometimes we will discard some true variables because the specification was wrong, and sometimes we are going to accept some variables where we should not because the specification was wrong. So there will be some false positives and some false negatives as a result of specification problems. Machine learning comes to our rescue by telling us this variable is important, regardless of the specification. Forget the specification is unknown, but these variables are important. So now that we know that these variables are important, we can build a theory which will lead to a specification that we can test through econometric models. So I feel that this is a missing link in many economic papers. In many economic papers, typically we start with a theory, which of course comes from data, observations, right? We start with a theory and then we try to evaluate this theory through econometric models. And instead, what we could do is we could come up with theories that are suggested by the data, that are evidenced by the data. And remember, in the sequence that I gave you, machine learning had no role once the theory is established. Once the theory is established, we don't need the machine, right? Why? Because we will run the theory. In the case of COVID-19, it goes like something like this. The sort of disruptions that were caused by COVID-19 are by no means new. Yes, for a particular virus, it's new, but economic disruptions, whether it is caused by war or by strikes or by short supply of a particular commodity, this is something that happens very often, right? Very often there are disruptions to the supply chain caused by weather terrorist attacks, etc. So what we need to do is we need to identify how to recognize these disruptions, where COVID-19 is just one particular example. So we can build a general theory of how to recognize disruptions to the supply chain, and then we will now cast predictions of whether this disruption is taking place today.
I love your picture of a sort of a relationship between forecasting, nowcasting, and data. In the social sciences, they often talk about qualitative theory, and it's sort of like they suggest the things that we might then look at in a more formal sense. And what you're advocating for, interestingly enough, is let's let these advanced machine learning types of tools tell us what's important, then we can begin to build a theory that fits with this. And that's a really sort of positive, wonderful view. Let me ask you the following question. No doubt you named your business True Positives because one of the great problems with a lot of forecasting is false positives, right? We extract through data mining something that we believe is true. And of course, it doesn't really exist out of sample. We know many ways to do that. I'm just wondering, in the nowcasting world, do we still have some of the same room for false positives, and how might we think in this very rapid world about trying to get around that problem?
Yes, so definitely whenever we are running a statistical test, there is always a risk of false positives and of course false negatives too, right? The error type 1 and error type 2. And in the case of nowcasting, it is the same. Now, nowcasting has some advantages. Number one, is typically relying on many different forecasts. So the probability of a false positive can be limited, can be reduced just as a matter of the number of observations. Mm-hmm. And number two, the power of the test is typically higher. Why? Because the signal is typically stronger on the short run. So in that sense, yes, we will have false positives and false negatives in nowcasting, but the good news is that because the relationships are more reliable and short-term, and there are more observations, the cases of false positive and false negatives are typically much smaller.
This world that you envision with nowcasting, which is very machine learning and data intensive, with theory that is now quite broad and encompassing. And then you mentioned both at our last talk and just now how the kinds of paths you would take career-wise are different. What does the modern trader look like, and how do you get there? Do you need to be a quant jock and know machine learning? Do you need to be quite advanced in theory related to economics? How do we get to the top these days?
I think these days you need to specialize at something. The asset management industry is going to be changed over the next 5 years or perhaps even less. This is driven by lackluster performance on one hand, and on the other hand, the appearance of so many complex data sets. And today, it's impossible to be a generalist. It's really hard to be good at everything. So that's where democratization comes in. What you need to do today is to become really good at something, whether it is data curation, feature analysis, strategy development, or the various stations of the assembly line that I describe in chapter 1 of the book. And once you become really good at those, that's what you need to do for the rest of your life. You need to become the best there is at that. So, if you're really good at feature analysis, do not become a portfolio manager, because a good feature analysis is worth his or her weight in gold. But that's not the way the industry used to be, right? The way it used to be is you have an entry point, and then you know that the portfolio manager is at the top of the pyramid. Mm-hmm. And that's where you need to become. Today is different. Today, there is no role that is more important than other role. Every role is extremely important, whether it is risk management, portfolio construction, execution, etc. you need to be good at a particular task and then keep up, innovate, do research.
That means to me, what I'm hearing is lots of jobs and lots of different types of jobs and a lot of new skills, which I think is fascinating. So when we think about going forward in this world, and again, this world of nowcasting and machine learning generating data, developing theories, testing theories, building trading strategies, and the lessons learned from COVID. What are the challenges we will see going forward? What is the next limit on the ability of nowcasting to be useful? What are the next big innovations you might see in the nowcasting world?
I think that innovation will never cease, right? Today, there is a tremendous amount of microscopic alpha. Macroscopic alpha is gone, right? The kind of alpha that you could just extract by, in Excel, by sorting some stocks according to their P ratio and, buy the bottom, sell the top, that's gone. Of course, it's gone. If everybody can do it, there is no need, there is no space for it, and nobody should be able to charge a fee for that. But there is a tremendous amount of information that is coming to the market today, whether it is transaction records or satellite images, regulatory filings, etc. All of this information needs to be mined. And once you mine it, you can tap this microscopic alpha that is much more abundant than the macroscopic alpha. Think of one metaphor that I like to make is when you think of all the gold that was extracted over the past 4,000 years, half of it has been extracted over the past 50 years. Half the gold that humans have mined for 4,000 years has been mined over the past 50 years when people thought gold is gone, it's depleted. That's when people started to apply chemical methods and industrial processes to extract a few grams, perhaps 4 grams per ton of earth move. That's the yield today of some mines. And that tells you something about the power of utilizing industrial methods and sophisticated analytics to now, will this mean that at some point in time, alpha will be eradicated? I think it will happen. That's a desirable objective, in fact, for society, but it will take a long time. Why? Because there is more and more data that is coming in. This is just the beginning of alternative data. When you think of all the data sets that have appeared over the past 4 or 5 years, this is only going to get better because there are more sensors around the planet. There is better telecommunication, more computing power, greater ability to store information.
Yeah, in some interesting way, we will move beyond forecasting things to just actually measuring them in real time in a way that we've never been able to. You and I have talked about inflation is a great place where we don't even have to think about what it'll be. We just go out there and absolutely know for sure. This has been a wonderful talk and exactly what I expected. Something very interesting, fascinating, and pushes our boundaries when we start thinking about what's happening in investing. So thank you, Marcos, for taking time with us, sharing your thoughts, sharing your insights. This webinar series will run one more week. On Friday, May 15th, Kelly Xu will be joining us. She's a professor at Yale, and she'll be talking about her paper, recent work, Can the Market Multiply and Divide? Non-proportional thinking in financial markets. So from sort of micro alpha and very quantitative thinking about markets, we're going to go to something a little broader and more general. So we very much hope to see you all here next week. And thank you again, Marcos, for a wonderful and fascinating talk.
Always a pleasure. Thank you.